that same model here, but what are we looking at? What are we seeing in here? We're seeing the underlying pattern that sets up key institutional volatility. And I'll show you what that looks like here in a second. Let me pull this up. So when we are in a premium and the market has traded up into some measure of a premium array. So what we're looking for in price action, we're not trying to second guess or guess rather where the swing highs and swing lows are going to form. We're anticipating them. Okay, so what we're looking for is an underlying market structure that is highly probable to present large injections of volatility in a directional bias. Okay, so what that looks like is here, if we have a premium, in other words, and we're in a market that has traded up, so we are, by our definition, overbought. We don't need indicators to do that. But relative to the present range that we're dealing in, using basically month 5 content, the way we define our underlying market structure, so we have a high probability scenario for bearishness, we want to see a high that's rated. Once that high is rated, those stops have been taken, and or they've engineered buy-side liquidity for false breakouts. There are traders that are trapped up here. Okay, so they have now someone on the other end of their position. So their counterparty offering buy-side liquidity, but to do that, they have to be a seller. So they're offering sell-side liquidity as price drops down. If they have a sweet entry place up here, why would they let their book go to a lesser profit or lose that profit once we're in a premium? Any retracements back up are going to be shallow. Okay, so we don't necessarily need a run all the way back up to here, like we would see a high to low, and then a 62 to 79% retracement level, optimal trade entry. That's why they never work. Because if it does go up there, this is going to get ran out, and this is going to be a continuation higher. Okay, so when we're looking at, and you'll just have to have a loss there, because I know some of you are probably thinking, okay, well, what if we see this pattern here, and we get stopped out? Then you have a trade that got stopped out. You don't learn 100% trading here. You learn high probability. So the context is, when we're looking for shorts, we want to see the underlying price structure do this. We have a high, run the high, break down, a short-term low is taken out, and then we trade back up into here. Essentially, it's the breaker. The swing points are not necessary. In other words, we don't wait for them. We want to trade at the level 10, 20, 30 pips above the high, short, if we can get some overlapping analysis ideas to support that, time of day, day of week. And then in here, we want to be trading as price returns back to the breaker, not waiting for the swing high to form. Now, when you do this style of trading, you'll see that you'll get the better entry points, and you can wait for the swing points to form to support the idea. Okay, so there's a difference. Much like when I first learned about the opening price by way of Larry Williams, he wanted to be a buyer after price rallied above the opening price a certain degree. I want to be buying below the opening price, at the opening price or below, ideally. That's high probability. Well, much like I taught in the foundational premise to Model 1, we now have the higher form of it without requiring the swing points. Everything's reversed when we're below the equilibrium of the current dealing range. If we're in a discount, the ideal scenario for buying is we want to see a low that's violated. Okay, once they run those sell-side liquidity, they engineer breakout artists that want to sell short on breakout, and or sell-side liquidity on assumed long positions in here. They're going to have a sell stop right here, protecting that position. And price goes down in there. They play counterparty, big displacement, breaks a high, so the market structure now is bullish, return back to the breaker. This is the highest form of market structure in terms of probability that you're going to find. If you just stick to situations like this, it doesn't mean you're not going to have losing trades. It doesn't mean you're not going to do it wrong. It means that in a 90% bracket, the highest probable points of entry are going to have this market structure here or this market structure here relative to the current dealing range.